could technology disrupt finance in South Africa? Well, joining me in studio is Ian Duvenage from Rainfin. He's going to let us know how peer-to-peer finance is taking off in South Africa. Hello.
Hi.
How are you?
Yeah, fantastic. Yourself?
Good. Well, we're talking about peer-to-peer finance today, but it's not something you hear about every day. So why don't you just explain what peer-to-peer finance is for us?
It definitely isn't something that you hear every day, but it is a common concept. I think it's part of the broader sharing economy model, where we focus on finance specifically, where you make almost banking a bit more personal. Where banking is almost doesn't say a big and scary model. We do that in an online environment. We connect borrowers and lenders more directly to share the benefits between the two of them. So it's almost a friendlier, more easy to use model.
And it's cutting out the banks pretty much.
It pretty much is. It also works with them, but it does cut them out effectively in some scenarios. But it is also an investment channel for them into the market. Because there's areas of the market typically that is not the focus of the bank, because it isn't consistent, it isn't the same every time. So we focus on those kind of parts of the market, and we open up those opportunities to investors.
How does this differ from crowdfunding? I think it's important to differentiate between peer-to-peer financing and crowdfunding. What's the difference?
So the major crowdfunding websites like Kiva or Charity Water, and there's multiple of them, they focus on, the model works pretty similar to ours, but the return expectation is typically different. A lot of it's done in the context of social, where it is more a donation where you really think someone needs it, and it's not a pure investment decision. When it comes to peer-to-peer in the space that we play in, it is typically retail investors, individual investors, or large institutions that actually have return expectation. And they're doing this as an alternative investment into an asset class, as opposed to putting their money somewhere else. So it's a very, very real financial decisions being made.
Well, give me an example of how peer-to-peer financing works. So why don't we start with someone, let's just start with from an investor's perspective, so people can really understand how it works.
Yeah. So if you don't mind, I'm going to start on the borrower's perspective to make things easier. In a traditional bank, you would deposit your money into your savings account in the bank, and you'd earn 3 or 4% interest on it. And they would then recycle that money in the bank, and they would lend it out to you on the other side at 10, 11 or 12% if you're applying for a vehicle finance or anything like that. And the interest rate spread is quite big, and you always wonder, where does that massive interest rate spread go to? In our model, we make it quite open and easy. Someone comes onto the platform, they apply for a loan, they set their own parameters, they set the interest rate they want to pay, the term they want the money for, and they need to specify how they're going to use it. We then go through a moderation process to ensure that it is prime borrowers on the marketplace. Someone wouldn't typically default. And then we promote that on a marketplace where investors can come in and make an individual decision which of those loans they're willing to fund. So it's quite easy for investors. They come in, they see all the loans available, multiple interest rate, multiple risk ratings, and they can then go and hand select. And it is, at the moment, we've got 2 types of loans. We do individual loans, which is unsecured, and we busy go into small and medium enterprises, which is quite an interesting space, especially for if you look at where our economy is at the moment.